Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. We hope you're doing well today. It's Wednesday, September 21st. The Fed day is upon us. We'll be covering that in just a few minutes. Before we do, as you can see, bottom left-hand corner of your screen, futures are off the lows from yesterday. We have breached uptrend invalidation, at least traditional impulsive uptrend invalidation in the indexes. We've also breached the June through July uptrend support in the S&P 500. We're going to take a look at the indexes in just a few minutes. And while I continue to look lower, as you know, I do view any move to new lows as an entry opportunity. And more importantly, before we get to those new lows, I'm seeing a potential larger rally or move squeeze to the upside on the horizon. So we'll get to that in just a few. Before we get to that, we're going to be bringing in the trading analysis team. And good morning, gentlemen. How are you doing today? Welcome, welcome.
Good morning, guys.
Everybody.
Hey, Fed Day.
Alex, what's up? What's up? It is Fed Day. I love these days. They're the best. Full of volatility.
I remember when, Alex, do you remember when non-farm payroll used to move the market, specifically FX? Like before that was money supply. And now CPI is the big day that everyone waits for. It's amazing how like every 5 or 10 years it cycles through to a data point that really, really moves the market. Like I've seen some pretty prominent guys, even who've been in the business for several decades, like this is the most important data point of my career. So it's pretty interesting.
At the moment.
Later it was interest rates and NFP. Those two was the biggest one. Now the CPI is the biggest one. So it changes as the things change.
Yeah.
Especially me, is good news is interpreted as bad news. Oh, the economy didn't have higher job reports, and then the market goes down. I'm like, this is insane. So
yeah. There was a long period of time where what's my word? Tepid data, slow growth, benign data was good. Anything bad was good, very good, because Fed wasn't going to raise rates, and any data that was good was very bad. It's a sick and twisted life we live in the market.
It's counterintuitive for many,
Right.
Yeah.
Right.
Same thing was just recently with the dollar and commodities. Over the decades of inverse correlation, you had 6 months going them hand in hand together up.
Right.
So all depends on the environment.
I mean, and I, not to get off on a big tangent here, but they say, we all love technicals. Obviously, we're paying attention to the fundamentals. I think we're a good mix between the two, but technicals takes a really bad rap in mainstream media, and I would say traditional academic studies, because it's too subjective. But to what we're just saying, like strong economic data is bad for the underlying financial markets. If talk about being completely subjective. So good data is bad. Okay, data is good. All forms of analysis are subjective, and it's how the collective market participants respond based on discounting how that's going to happen in the future. It's all a very subjective practice, whether technicals or fundamentals, and projecting how the marketplace will react to that data. It's just more so an exercise than psychology, I think, is trading, mastering your own psychology, and then separating that from the collective marketplace psychology. And that kind of void between the two is how you put money at work in a risk-protected way with a favorable reward based on that disconnect between what people think is happening, what's expected to happen, and discounting, as that data is coming in, both fundamental and technical. It's science, it's math, it's art, and it's psychology.
Yeah, I will just add to that from my experience. I think that definitely technicals are something to be looked over fundamentals if you understand the lower time frames. And as you go bigger on a macro level, fundamentals will go hand in hand with technicals. So I think there is a layers to it.
That's a good point.
as you also progress through your career towards purely technicals, now including more on a macro level, more of a longer term fundamentals and technicals together. So it's kind of a switch from trading to the macro and back and forth.
It's so funny, and so many of the macro gods who have made billions are having a very hard time. I would say in the last 5 to 10 years, because the macro landscape has changed very much, and a lot of the big macro hedge fund guys have made pretty loud, definitive claims on where the market's going, and not a lot of them have played out. I know a lot of them are very bearish right now, and you got to think, guys at that level, they're making definitive statements and market projections. Like, are they doing it to help you and help us? I don't think so. So I don't know. Anyways, too much of a tangent. Let's dive in. Let's give these people some good content.
Small ad. I looked. Druckenmiller was on one podcast, and he said over the 45 years, I've been someone who kind of use macro and environment to predict. And he said, I don't have a clue what's going on and where the markets are going to go. This is the hardest environment I have ever been in, and I'm the one supposed to tell you where it's going to go. I don't have a clue.
So it was really funny.
He's really an honest guy and kind of straightforward. Yeah.
That's funny. Actually, and by the way, I don't know if anyone's going to New York City, but I'm going to go to the Delivering Alpha Delivering Alpha event in New York City. CNBC is putting it on. If anybody's going to be there, let me know. Hit me up, and Stanley Druckenmiller is going to be there speaking, so we'll get to see him, see what he says.
Nice, very good. Yeah, I was going to say, with that in mind, Alex, perhaps now is when traditionals can really shine. And speaking of, let's take them through the indexes. Anything specific you guys want me to cover while I'm at it?
Just tell us where the market's going, bro. Nice and simple.
Oh yeah, very simple.
I'm seeing some strength coming back in the financial sector, in addition to the consumer discretionary sectors. So there's some improving conditions there.
All right, sounds good. Let's hit it. Hard right edge. I'll be back in just a couple of minutes. Catch you guys then. All right, let's hit it. Hard right edge of the MotiveWave platform. We're going to go full screen on the trading analysis edition, looking first at price action in the S&P 500. And as you all know, I continue to remain bearish, although I am well aware of the alternates that could either, sorry, 1 second. I just saw a note come in regarding audio. I think we're good. Okay, so that is on your end. Sorry about that. So I am well aware of, while I am continuing to remain bearish given the fact that we have invalidated the traditional impulsive uptrend in the indexes, I am aware of, given the complex environment that we currently exist in, of the alternate possibilities. And that is exactly what we are kind of tracking and digesting with our clients at Trading Analysis, looking for the best ways to trade in this environment. And with today's Fed decision upon us, I see two clear possibilities moving forward. And this is something that we will have to track throughout the day. So let's just hit it here first on the daily time frame, going back to the January highs, where really I will continue to kind of reiterate my view that this best counts as a series of Elliott wave corrections. Therefore, even in the event we do break south of the June area lows, which I do believe we will, that would then be viewed as essentially the end of the downside correction and a long entry opportunity. It would present a long entry opportunity. So I am not going so far as to say that from January in through June, we have a big impulsive or a big motive wave, a motive diagonal wave down that would suggest we're now going to see a 100% or 161% move compared to the initial 2022 decline. So I just want to make that clear. Although I am bearish, I am not looking for the larger bear market potential that so many are suggesting is upon us. So looking at the chart, as you know, and as we've been discussing, the break under 39.45 in the S&P 500, I view to be a significant event. The break under 39.45 invalidated the traditional impulsive uptrend, and we knew this pullback was coming, and we knew August would be the zone that the indexes could either prove the uptrend by consolidating in a fourth wave position, which would then give us the clarity to secure the June lows, or we knew alternatively, in the event we see a MotiveWave down through 39.45, that would be our first sign that a move back to the June lows and probably a break through them is in store. So looking at the chart, we'll just go ahead and zoom in here on, we'll take you all the way down to a 195-minute time frame. And we like to use the 195 versus the 240-minute 4-hour time frame, as it gives us exactly a half-day session. So 2 bars represent a full daily trading session. So going back to the June lows, which, by the way, from the June lows, we see a move up in A. We have this expanded B wave where July 14th, the S&P gapped down, we found support, and then we start the summer rally. The summer rally takes us into August 16th, and it was thanks to viewing the lens through the viewing the indexes through the lens of the Elliott wave principle that we were able to essentially identify the hour in which the uptrend from July 14th through August 26th would reverse. We were able to take a short position with our clients about 1 hour before the top. And again, that was all thanks to viewing the markets through the lens of Elliott. So now, from August 16th down into September 6th, we see what is best counted as a 5-wave decline. So we have another trend-establishing MotiveWave. And I was having a discussion yesterday on Twitter in regards to the wave count and whether or not this is wave A or if this is wave B. And I had to kind of take a step back and say, at this point, given the complexities of the pattern that we've seen, it really doesn't matter. If we break it down in the most basic of Elliott concepts, we have, from June through August, a 3-wave trend. That 3-wave trend, I believe, has been confirmed as a 3-wave trend now that we have 5 waves down south of what would be the June 28th A wave high. So you've got 3 waves up, you've got 5 waves down, which would suggest the move in through the summer was corrective and that we are now continuing the higher degree downtrend. So what that means is that from September 6th, which, by the way, it is important to note that the bounce on September 6th came at exactly the June 16th through July 14th trend line. If you draw a trend line establishing an uptrend there, that's where we bounced on September 6th. September 6th yielded a move up above downtrend line resistance. Downtrend line resistance is sourced August 16th and confirmed August 26th. You'll notice we get a move above resistance. We reject the 50% retracement of that 5-wave decline from August 16th in through September 6th. And now we've got another move down, as you can see here, that has taken us beyond this shorter term uptrend line support. But what's very interesting is we're starting to see some divergences in here that would suggest, given the positive divergence, that perhaps the green B wave is still an ongoing ordeal. And what's really interesting about this possibility, which I emailed you all to these charts last night, if this is really an ongoing B wave event, then it kind of fits the idea that prices tend to go to the most obvious places in the least obvious ways possible. So allow me to kind of walk you through this. With the break under uptrend support, many bearish traders and investors are probably celebrating in victory, assuming that we are immediately moving to new lows. Whereas if in fact this B wave is an ongoing ordeal, it's entirely possible that we're doing an expanded 3-wave subdivision, which is exactly what we saw back here, meaning wave A takes us into September 12th, wave B takes us into the lows here that we're rounding out now. We could potentially see a rally all the way back in C of B before turning lower. So this is something we're going to be tracking with our clients today in our member webinar and looking for the best ways to trade this and obviously identifying some key levels that we can use to determine if that B wave is really ongoing or if wave B is over. If wave B is over, we likely just have a 1-2 and we'll probably see the continuation move to the downside. Now, yesterday, Apple closed up 1.57% while the indexes were down, and I felt it would be appropriate before we get to the small cap index to take a look at the chart of Apple. And here in the chart of Apple, we are tracking essentially the same possibility. And this is a very basic chart that takes into consideration support that is offered near $150 a share. And we don't have to go back very far to see the significance of that level, acting as support in March, acting as resistance in May and June throughout the summer. We get the break above it. The break above it establishes a lower high compared to March and January of this year. We do a 5-wave move down the same way I'm tracking it in the indexes. We retrace in the B wave, meeting a 50% retracement of this 5-wave decline from August 16th into September 8th. But now we're up against the same possibility, meaning it's entirely possible that Apple breaks downtrend support, or correction, downtrend resistance here in white from the August high through the August 26th high, which you can see we rejected perfectly on the 12th. So the question becomes, do we break upside downtrend resistance before we break the downside 150 area support? So it's entirely possible that we do see a bit of a bull trap. I would view this to be a bull trap. It would cause the bears to question their conviction and result in the bulls celebrating in a premature victory lap, as I would jokingly call it, because I do feel that we have another secondary move to the downside here in shares of Apple. Now, before moving away from Apple, I just wanted to put this chart into perspective, because the question was asked as to whether or not this could be B and this could be C, and I just don't think that's the case. The reason I don't think that's the case is due to the fact that when we take a step back out to the weekly time frame, first of all, we've had some fairly significant divergence taking place into the highs. We had 3 instances of relative strength divergence on the weekly and daily time frames. And with a break forecast under the 150 handle support, the next most logical zone of support would come in near 137. And that's where we find a confluence of both uptrend line support, previous resistance, turned support, and also the 78.6% Fibonacci retracement of the rally from the June lows. So that confluence of support tells me, when viewed in combination with the relative strength divergence, that perhaps that is the next likely downside target once that B wave is deemed complete. So we continue to look lower, but we do think it's going to be a tricky environment from a trading perspective. We would encourage you all to join us at tradinganalysis.com if you are interested in more coverage there. And then 2 final quick charts here. Russell 2000 small caps, WX, YXZ. I'm tracking the exact same wave count. We're looking at the exact same possibility in that this B wave could extend on us before the C wave decline sets in. Really, if B is over and we're already doing 1-2, then we're just going to see a move into wave 3. We're going to see markets expedite into wave 3. Whereas alternatively, if for some reason we catch a bid following today's Fed decision, maybe we do get a full rally in C of wave B there. And then over to the SMH to wrap things up. Same situation. We can count this as 3 down, a sharp X wave, 3 down, a sharp X wave with 7 price swings. And same thing here, AB or the B wave is extending. So it's a tricky market. We'll continue to keep you updated. You can, of course, check us out anytime at tradinganalysis.com and sign up for our mailing list if you are interested in more information. All right, back over to the team. What do you guys think? Extended B wave, or are we going to go right to new lows? Or is the low in? Or is the low in? Is the low in? Am I just flat out wrong?
It's so hard in here. I'm leaning. Bennett and I have been talking about this. I'm leaning a bit more bullish, just for kind of a bunch of other things besides Elliott. But listen. I've got cash on the sidelines in the wealth management business. I'm taking it day by day. I can't remember in the last 5 years that I've watched the market so carefully. I think the future is not written here. I think there's times where the market, there's a way you can kind of put all the pieces together, figure out where the odds are, where the probability would go. I think it's 50-50 in here. I really am trying to not have much an opinion, just take it day by day. I mean, how's that for a dodge?
No, you're completely right, and that's exactly why we have been tracking the multiple possibilities with clients and really staying on top of any trades we put out and managing them, because we are in a unique environment that has the potential to reverse in either direction on a headline.
Yeah. Alex, Terry, what do you guys think?
I'm just waiting for, like you, I'm waiting for clarity to reveal itself. But while I'm waiting, I'm not sitting on my hands. And if you guys been following me, you know I've been scouring the ocean of stocks, looking for those particular sectors and stocks within those sectors that are outperforming while we're having this broader market weakness, and I'm compiling those into my watch list. So when we get stability back into the markets and reestablish a new uptrend, I've got a go-to list that we can start re-adding things back into the portfolio. Right now, you can play trying to catch a falling knife. If you want to go short, you can be speculative, trying to jump in early and get stopped out. So it's it's hazardous in the markets to trade when the trend is unclear. That's my perspective.
Yeah, very well said. And to your point, Terry, not only are we, capitalizing currently on the short side with clients, but to your point regarding being prepared for when that lows present, we're also actively looking for those opportunities and compiling our watch lists. And because the last thing you want to do, as Terry mentioned, is wait until the reversal presents, and then you're scrambling to find the opportunities.
Yeah.
All right, what's up, Todd? You ready to rock? You got the screen? You good to go?
Yeah,
Go ahead, Alex.
Just one add. Yeah, so I've been faced as you thought for who knows how many times when you have this kind of a no man's land. So we don't have a clear signs. There is an impulsive move down, and we don't have a reversal point. So it's a kind of a no man's land which you need to see through and kind of prepare yourself. So I'm pretty much in line with everybody of you is saying, either from technical side or from the fundamental side, you will see that we are just need to sit and wait.
Yeah.
Yeah. Go ahead.
I was just going to say, not all of the puzzle pieces do fit together right now, taking into consideration the consumer discretionary stocks and some of the moves we've seen there. And, the consumer discretionary sector wave count still remains valid in an uptrend. So it is a tricky market.
And I'm seeing what Enduromom is saying there. It's so hard to do LIQUIDITY right now. I've been through this a lot of times, and when it's hard to do Elliott wave, 61.8% of the time you're in a correction, and that tells you, corrections are hard to know where you are with certainty at the time you're in it. So that you can hear us going back and forth, looking at all sides, and we the team that we have here behind the scenes on our Slack channel, the guys are constantly having discussions, going back and forth, looking at all sides of the equation. And the takeaway is, if it's hard to do Elliott wave in here, it's probably a correction, and that's kind of market environment where you want to be undecisive. You want to be protective. You don't want to really stick your neck out there and take a lot of risks. So Elliott wave, in my point of view, is doing its job right now. I think, and Bennett is saying the same thing, it depends on the time frame that you're looking at. We are in a corrective manner, whether we've seen the lows and we're starting to move out of the correction, or this is some kind of second X wave. We're going to do another ABC down for another 3 to 6 months. That remains to be seen. But the takeaway is you got to be protective in here, because it's hard to figure out exactly where we are.
Yep, very well said. And the only thing I will add to that regarding when you are having difficulties, perhaps, deciding between a preferred and an alternate wave count, one thing that you can do in this sort of an environment is look for the subdivisions within patterns that are being expressed in both wave counts. As an example, going into the August high, we knew that was either going to be a wave 3 high or a wave C high. So both anticipated a corrective pullback. So there are certain areas within trends that you can take advantage of, but overall it has been a very tricky year, and I continue to view it as a correction.
Yep.
All right, you want to take the screen?
Sure. Yeah, I'll
right.
just throw some stuff at you. All right, thanks. I'll be quick. I know we took a lot of time, but I think it's important. All right. So, I saw Enduromom there talking about small caps, and I just can't help but look at this relationship here on the relative rotation of small caps to the large. The first thing we can do is focus on small cap Russell 2000. So the further you are to the top right, the more relative strength that you're showing. So right now, of all of the different market capitalization ETFs, the small cap growth is actually showing the most strength. The Russell 2000 value is right here in white, and we've done a pretty good, we're falling out of favor here, but then it did a pretty good hook and has been rejected from sort of this hemisphere line here. So small cap value, Russell 2000 small cap value is showing strength. So the takeaway is there. Small caps are showing the most relative strength right now. And this is what Terry said earlier, that you want to get your shopping list together. I think you have to take it one step further with these small caps. If you are getting that shopping list together, I think the US dollar strength is a major reason why you're seeing small cap outperformance now, because they don't have to deal with their earnings overseas, doing a foreign exchange trade and taking home less dollars that go onto the financial statements, because obviously you're going to bring in less dollars if the dollar's strong, if you're making money overseas in a weaker currency. You really want to pay attention to what Alex is seeing on the dollar, and I think we are approaching upside resistance in the US dollar. So I wouldn't look for this small cap outperformance to continue. So let's take small caps out for now and just focus on growth value. Value, this is a week over week basis. Each one of these little dots is 1 week of trading. So this is going back into July, into the summer. We've done a little bit of a scoop here, a move up in value, but it's still over here in the bottom left, which is lagging, where growth, I should say, has come into favor. So this is up in the leading quadrant. It is starting to lose some upside momentum, and we are losing a little bit of velocity, but the fact remains that growth continues to be strong. And as Terry said, actually Bennett said it, consumer discretionary, if you get into the guts of this a little bit more, looks to be one of the strongest sectors out there. Within consumer discretionary sector, you break down into the industries, and they're very price sensitive, inflation sensitive industries like auto parts, hotels, travel, leisure. These guys are doing really well, and that doesn't square up with the inflation narrative that they are jamming down us. And so many people are just pounding on the door that the energy trade is the best pullback buy. And those two, that narrative of what we're seeing is everyone's saying buy energy, but yet consumer discretionary and price sensitive industries within consumer discretionary are so strong inside of this growth observation. That doesn't square up. So it's very strange in here when you're reading the tape within that. But for now, while the stock market is not completely falling out of bed heading into today, those small caps are showing pretty good relative strength. So if we just go 2000 right there, 2000 growth, I'll pull up the chart. Another way to look at it is that should be it right there. So this is the IWO Russell 2000 small cap growth, and you can see this relative to the S&P. This guy's moving up very, very well, and you could still count a possible wave 4 that's not moved into the territory of wave 2. It'd be 1, 2, 3, 4. So small cap growth for now, while the market is keeping its head above water, we'll see what happens to the CPI. Looks interesting. So to Terry's point, it's important that you have all of your list of stocks outside of just the S&P 500. If you want to be actively trading here, you absolutely can. All right, let me just keep moving through here. Just a couple other observations that I wanted to throw in front of you guys. This is put to call, and I think the lack of any real waterfall implosion on the downside and the VIX persistently stuck in the 20s, I find is interesting. And I want to just look back here, pretty much post credit crisis 2008. This was a little sell off there, 2011 and 12. you had the put to call ratio here in blue move up. Obviously, if put to call ratio is going up, more puts are being bought than calls in the SPX options, which is going to drive the VIX up, VIX down there. Then you had it again in 2015 and 16, a good VIX, a put to call spike. I've got a 10 period moving average on here on put to call to kind of smooth it out. This is the S&P in red. So you had a good spike up there. Not too much of a spike in volatility right there. The VIX didn't get very high, which is interesting. But then, here's 2020, the S&P sold off, massive move into options. And the higher that VIX goes, the more bid up the at the money options, both puts and calls are. And that's how the VIX is calculated. So you look at where we are now with a percent change drop, which is very similar to the COVID drop, with volatility nowhere near what we've seen in prior spikes. I mean, it's equivalent to 15, but it's certainly not 11 and 12 or 2008. So you look at the moving average, we're nowhere near on the put to call. The demand for the hedges in the options market is not there, yet we're in 20% plus S&P drop and a 28% in the NASDAQ. It's interesting. So why is the market dropping, and why is there not a persistent demand for hedging? I don't know if that means there's another leg to drop, as Bennett's saying, and we're going to get that next move down, and that's going to push the demand for put protection, or this is more of a macro-driven interest rate move rather than a stock market move. We've had interest rates normalizing. I threw a chart up there on Twitter, and I find this pretty interesting. If you look at the, let me just find this here, treasuries. You look at the move lower in bonds, okay, across the curve, 30s, 10s, 5s. 30-year bonds dropping, 10s dropping, 5s dropping, making new lows. But look at the volume that's happening. The volume, and this is post-Jackson Hole, and there was a bond auction in here as well, but this was leading into Jackson Hole, where Powell made that alarming statement about pain to come. Look at the volume drop away in these. So bonds are making a new low, which means rates are making a new high, but the volume is evaporating. I mean, just look how small that volume is in 30s, 10s, and these are 5s. Actually, those are 2s. That's mislabeled. Sorry, that's a 2-year treasury right there. So you don't have you have interest rates moving a new high on a low volume move. The NASDAQ, which is very correlated, is not following that. So is it more of a fixed income move, and there's programmatic selling, and there's not just pure capitulation, people get in there rushing to protection in those S&P options? So, I don't know. Just bouncing around real quick here. I'm working on the longer term count of Apple. I mean, listen, that's a monthly chart of Apple. Sometimes I like to take the labels off and just say, all right, take a deep breath. That's Apple. You see a crash coming in that chart? Not so sure. I'm not so sure. Okay, it's Apple's showing a lot of relative strength. I threw a Tesla long on. I shared it with our members in Discord, and let me just show you this here. I'll show you the options trade. Tesla is showing a lot of relative strength. Consumer discretionary, as already mentioned, is showing a lot of relative strength. So this is the daily on Tesla. Okay, there's a couple different ways to read this chart. This is one interpretation that is bullish. Tesla is one of the largest holdings in our growth portfolio at the wealth management business, and it's showing a ton of relative strength. So if that's all of wave 4, look at Tesla ready to break highs, the summer highs. If we do make a move up there in Tesla, you're looking at a move into 330, 340, 350 into upside wave 5 fib resistance. Okay, if wave 4 is not over, as I have labeled, and we're doing some kind of triangle, A, B, C, D, E, maybe just one more little push, and then we move higher ultimately in Tesla. So the trade that I have on, I don't mind showing with you guys, just a little option trade that I have on. I have it over in Schwab, but I like to show it in TD Ameritrade just because Thinkorswim is such a good platform. Can't wait for Schwab to pull that in. So this is what I have on here, just Just a little broken wing butterfly here. So this is the exact trade I put on in October 21 options. So buying 4 of the 330s, selling 6 of the 340s, and buying 2 of the 350s. So that's what they call a broken wing butterfly. So 756 of risk, that's my max. If you get a pin up to 340, you make $3,200. And then if it rips higher, you come off here and you only make 1,200. And I'm watching that teal line right there. So a little bit of an upside option hedge. You know, as I said, I have some cash in the sidelines. Okay. Round this out real quick. Tom Lee put in some really good work this morning, and just looking at let me just make sure I don't screw that up. 65. Tom Lee in his premium research this morning said, like, everyone's talking about the stagflationary 70s, the inflation and blah, blah, blah. I thought this was a really interesting chart that he put up there. So in purple and orange is the core and the headline CPI. Blue is the S&P. And every time back in the 70s, if we're in the Volcker age, every time inflation made a high reading at the core and the headline level, look what the S&P did. It bottomed. Inflation made a peak, S&P bottomed. Inflation made a peak here, S&P did break out, and then we did sell off here into 1982, and then inflation made a peak here, and then we moved up. It's hard to make a comparison where we are now because the headline and the core are so scattered, and you don't have the movement in the CPI that you did back in the 70s because we just started to see real movement there. But you can see the market's moving up. You know, perhaps are we starting to make a peak, and maybe the market, whether it's bottomed here in June or it's going to make one more low, do we push up? Last thing I'm going to say is, if you like, take a look at my Twitter, Todd Gordon TA. I had a nice back and forth with Tom Lee. There's been a lot of debate over the 2-year Treasury telling and everyone taking it as gospel that that's where the Fed funds rate is going to go. What's going on here is if you look at the spread between the 2-year and the Fed funds rate, so that's a 30-day Treasury bill rate compared to the 2-year. They track each other, but there's a lot of instances where the purple, which is the 2-year Treasury, will get ahead of the Fed funds rate. And when that happens, the ratio down here will get up to a level of 1.98, 2.25. This got up to 3.5 back here in 1984. And you can see the purple 2-year got ahead of where the Fed funds is. So right now, the point of me bringing this up is we have a good 150 basis points premium of 2-year Treasury yield on top of the Fed funds rate, and the Fed funds is going up another 375. That spread is going to narrow, and the point here is if you look at resistance of Fed funds and 2-year, 3.5 here back in 1984. You've got a big move up here in 1994 where the spread got up to, I'm looking at this number right here, 2.75. Right down here, spread got up to 2.25. Right here, the spread got up to 1.5, 1.98, and then we had about a 1, right about here. I think we had like a 1% premium right there, where the purple 2-year was trying to pull the Fed funds up, but ultimately Fed funds pulled the 2-year back. So what I'm saying is we might start to see a tightening. We've already seen a tightening of these short-term yields. So maybe everyone is saying with a 10-2 inversion, recession is imminent. But when you look down at the 3-month, the 10-year, it's not there. And there is a precedent history of the 2-year being too eager, trying to suggest where the Fed funds is going to go. So I wouldn't take that for gospel that the Fed is going to raise us right into recession, even though they're being vocally very strong on trying to fight inflation. Their words and their commentary is one of the tools they're using. So just don't, there's so many people, a lot of my friends on CBC are saying 2-year is where the Fed funds is going. No, there's a spread between the two, and there's case for it to be resistant. So sorry for taking so much time, guys. Back over to you. Bell's open.
No worries. Excellent coverage as always. One thing I want to quickly point out before, and if you could pass the screen over, or Terry, if you could grab the screen. No, you're good. You're good. I just wanted to show you guys this. Alex is going to take you through the dollar. Regarding the dollar approaching resistance, I saw the request, forgot to cover it. This chart supports our overall collective sentiment here at Trading Analysis, and that is that we are in a correction, even if we get the new lows that I'm looking for. What I love about this chart is when we dial into it, first of all, the dollar's been in an uptrend since 2008, and it was only within this B-wave spike and in this final move that it's really been deemed to pressure equity markets. And zooming in on the final fifth wave, going down to the daily, you'll notice we have been seeing relative strength divergence compared to the wave 3 of 3, which is very typical of a 5-wave trend. Zooming in on the daily, we continue to hold the 50-day moving average. Our orange wave 4 was equal to orange 2. We get up into the wave 3 resistance, back off, break resistance, pull back to the 50% retracement of the uptrend from August. That also simultaneously was the 50-day moving average. And what do you notice about this wave count? It calls for a series of 2 new highs that should be terminal to the uptrend in the dollar. The same way I'm viewing the index is to have a series of consecutive lows, 2 new lows to finish its downside correction. So I find that interesting. Alex, maybe if you wanted to touch on that as well, dive down into the daily, we would greatly appreciate it. All right, Terry, sir, you ready to rock? Take us through some additional sector rotation. I think you are muted.
There we go. Let's get it on.
All right, sounds good. Take it away.
All right, let's take a little bit of step back here and on the daily time frame. Hello, traders and investors. I'm Terry Long at tradinganalysis.com with your weekly sector focus. So last week's CPI numbers revealed less progress than traders and investors expected had been made in the Fed's inflation fight. Thus, the markets reversed course last Tuesday with a deep push lower and follow-on declines for the rest of the week. It moved both indexes below their prior week's close. Today's Fed day, the markets have priced in a highly anticipated 75 basis point rate hike. Traders will be watching closely for any deviation from the Fed announcement path to recovery, and markets are likely to remain volatile. Now, last week, the S&P declined a net 4.77%, while the NDX fell 1 percentage more, down 5.77%. Last week, all 11 sectors closed lower. You can see here, last week's strongest performing sector was healthcare. Although it did close down 2.34%, it was the outperforming sector of the week. Last week's worst performance came in materials and industrial sectors, which were down 6.62 and 6.38% respectively. Now, fast forward to this week. Price action so far in the past 2 days has been reluctant to push significantly in either direction. And as of yesterday's close, the S&P was down 0.45%, while the tech-heavy NDX is relatively flat before market open this morning, down only 0.08% in 2 days of trading. Now, the best performing sector at yesterday's close was the technology sector, shedding only 0.02%, so essentially flat. The industrial sector in second place, only down 0.38%. Now, pre-market action, well, it's not pre-market anymore because the market's open. Let's just pull this on over here and take a look. This is live data in this table here. We have the industrial sector up 0.63%, followed by technology up 0.57%. This is for the week, not the day. Staples is getting a positive bid, and so is energy, just slightly positive. Worst performing so far in the 2 days plus this market open is the healthcare and the real estate sectors. Both of those actually peeling back. The losses yesterday were where real estate was down 3.69%. You can see it's down 2.73. So it is getting back a little bit of what it gave up in the first couple of days market action. Now moving on to our relative strength. Whoops, let's get over here. Wrong chart. Moving over to our relative strength sector leader scoreboard. Still holding first place with a relative strength score of 103.9 is the utility sector. Though it has seen a little uptick in momentum, it does remain down here in the weakening quadrant. In second place is the consumer discretionary sector, which continues to add relative strength gains as it moves further here into the leading quadrant. Now, the energy sector here continues to recapture some upside momentum, moving back up the list now in third place here with a relative strength score of 101.2. However, it still does remain down inside the weakening quadrant. Now, last week on the industrials, we saw it push across the line here and enter the leading quadrant, though I mentioned the velocity of the move still indicates a very hesitant advance. The staples and the healthcare sectors, you can see here, have moved further down the list as they are showing continued declines in their relative strength. Matter of fact, healthcare is actually on the verge now of possibly crossing over into the lagging quadrant as early as next week. Now, the technology sector does remain up here in the leading quadrant, though it does exhibit this yellow trend, which indicates a weakening price situation on the weekly time frame. But it does still remain, like I said, in the leading quadrant and technically outperforming the benchmark S&P. Now, sectors with relative strength below that of the benchmark include the real estate sector, which was down 6.25% last week, another 2% or so, like I said, this week so far. And with that big loss, it does continue moving in a southwesterly heading, adding to relative strength losses. The materials and the communication sectors are also remain down here in this lagging quadrant, though the materials sector recently has been seeing some rising momentum as it progresses a hook formation. Would like to see a little bit of more turn to the right. Okay. Now, the same cannot be said here for the communication sector, which looks to continue in its lagging state, and it does remain the worst relative performing sector of the group. Now, the financial sector shows a different characteristic. With a rising blue improving weekly price trend and a northeasterly heading, this sector is actually gaining both relative strength and momentum versus the S&P as it pushes through the improving quadrant. Now, if I flip over to, let me find the XLF here. I'm going to flip over to the details here. You can see this week we've got a lot of positive price action happening here in the financial sector. Pop up the weekly RRG of the top 30 large financial stocks. And as you can see here, there are quite a few of these financial stocks with rising blue improving trend vectors, and several of them are already staged in this improving quadrant, looking to add to this established group that's already holding out over here in the leading quadrant. In fact, there are only a few of these large caps currently exhibiting any sort of weakening condition. Moody's has got a little bit of a decline there. Citigroup, you can see those yellow vectors. And there's not a lot down here in the weakening quadrant looking to push into the lag. And everything in the lagging quadrant now looks to be recapturing upside momentum. I see a very positive future here over the next several weeks as more and more of these improving stocks add to their position in the leading quadrant, and ultimately that will continue to push the financial sector back up here into the lead. Would not be surprised to see this XLF start climbing this ladder, just as we've seen the XLY do, and while the XLK takes a little bit of a pause. All right, that's all I've got for now. I'll send it back to you.
Very good. Much appreciated, Terry. We'll get Alex set up to take us through the macro scene. let's continue to monitor the developments there in the energy sector. It's quite interesting to see the way the rotations are unfolding this year. All right, Alex, sir, let me know when you've got the screen ready to go.
He's muted. Alex, you're muted. But you're good.
Sorry, guys.
No worries.
Yeah, I'm good to go. Everything is set up with the screen.
All right, take it away, and we will be back on the other side to wrap up. Catch you guys in just a few. Take it away, Alex.
Hey guys, let's go over quickly over the couple of macro themes. So Fed meeting today, 82% for the 75 basis points. Everybody is expecting that. We have seen after the latest CPI data, 1% rising up, but consequently it moved lower. So I think there is not much of a probability we go full percentage point. So if you go on the 2nd of November, we are looking 60.4% that we're going to go from 3 to 375, 4%, which is a target rate, which most likely depends, of course, on the next couple of data we have in between. Will be the case, and the question is how we go from there. So what I want to go over the charts today is a couple of things. So rates are still moving higher. We have this on a 10-year yield. It's a larger time frame, and I always showing this because of this technically very unusual high RSI reading. Almost in the last 40 years, we didn't have such a big reading. So I think technically, if we look also, if we put Elliott wave here, we are in the region from where I can see a possible pullback, which is going to be of a bigger or a smaller magnitude. And I think it's going to last for some time because the rates are not moving that quickly. And I want to show you also something. Let me just find this chart, this is a TIPS, which is a Treasury inflation protected securities. And this is something, of course, which doesn't offer that much of a rate, currently trading at 1.15. But what we can note here from the Elliott wave perspective, which kind of agrees with this potential hypothesis or thesis, what we might going through in the next couple of years is that you're going to see technically something which we do see in the Elliott wave world as a 5-wave impulse on the upside, with the 5th wave as ongoing matter currently. So what this also implies that after a corrective pullback, which might take a month or even a year to unfold, we are going to most likely face another push on the upside, which kind of agrees with this overall outlook that after a correction, which might give us a new high on stocks, we are going to face some environment, and that goes into some of the longer term timeframes that we discuss internally among our team, that we are going to potentially face a bigger, let's say, a correction or a sideways movement in the years to come. But we will come to that. Let's go one wave at a time. So I think we are going to face some type of resistance, and that we are going to go and see a corrective pullback, which kind of agrees with our outlook that we are going to look for some type of a tradable lows in stocks. Also on the European front, our assessment that we are in the intermediary wave 3 kind of goes pretty well. We flagged this 4th wave pullback on this channel. We are moving up to complete this wave 3. ECB moved 75 basis points in the last meeting. They announced more. I think they're gonna also start to catch up, but they don't have a propensity of moving up as the Fed is, because the economy and even going further in the Ukraine-Russian conflict, which is heating up, I don't think that propensity will actually expand. It will actually narrow, in my opinion. So this correction is also most likely visible there, which I think is going to come very soon. With some type of a pause or a sideways movement before we go slightly higher up to 225, 250, which is a kind of a reasonable take for the ECB rates when we see where are the readings of inflation in Europe. So as the dollar is concerned, my chart stays unchanged, completely in agreement with the Bennett's charts. Even if you take this as an ABC x ABC, you're going to see a further, very soon, a move lower of a smaller or bigger magnitude from the dollar side. We are slowly coming very close to this Fibonacci cluster, which comes from 112.85 to 114.55. We can now slowly start to see very clearly that the wave 3 of the intermediary magnitude is over, that we are in the last sequence, which we usually label as a wave 5 of this whole move. So I think all of this kind of corroborate with the outlook in rates, and I think we're gonna see a dollar backing off pretty soon in the next couple of weeks, moving lower into some type of a corrective pullback, which will take some time, which also agrees with rates. When I look the commodity spectrum, Thomson Reuters index are still functioning very nicely with our predictions using the Elliott wave. So clearly a 5-wave move on the upside. Now we are in a corrective pullback, which is still ongoing. Oil is lower. Net gas in States are kind of a sideways, but I think we have a little bit kind of a more upside momentum there. Commodities are still, in my view, especially a couple of soft commodities, are still in a corrective pullback, and I look for lower prices. And as one billionaire said on the CNBC yesterday, I think that the Fed is operating with the old data, kind of a move markets. I think that's completely true, and that these are still going to be seen in the CPI moving lower as we go ahead. So on the oil chart, I still have a view that we are going to have a pause, and that with the possible stock market lows, we are going to have a little bit lower levels. And I do almost on a amazement of couple of guys that I had comment with, I still do label this as a 1-2, which kind of goes with this inflationary scare ongoing in the next couple of years. I don't like a negative or a kind of a campaign that we can see everywhere, kind of attracting fear. I'm just looking objectively because I don't believe that this is a top which is actually can be counted as a truncation. So for now, as long as I'm seeing this in a corrective mood, not doing anything impulsively to the downside, I have to stay with a trend, and that is the main kind of a point when you look at the larger time frames. So let's look net gas. This is the Henry Hub futures. My best case scenario is that this correction is over, and that going seasonally into winter, where the gas, of course, is going to see, especially with this, what's going on, a higher prices. This goes well with that, and possibly we can start labeling this as a potential already start of the 5th wave on the upside, being this wave 3 and 4. So still bullish on the net gas, and this is seasonally, this wave count makes a lot of sense. So soybean, just a quick update. I've been looking this on the upside in a B wave, still ongoing, but I still go with the prices lower because I see the 5-wave sequence already over, and I see this as a corrective pullback still ongoing with the lower prices ahead. Let's look quickly gold and silver. So these charts are kind of announcing a potential 5-wave move up in silver. So we still don't have complete clarity, but as you know, I like to look for a higher time frame confirmation. We are holding this level with the possibility of tracing a full 5-wave recovery, but I think that will not still be enough to confirm the reversal, although the pattern now fully complies with the 3-wave pullback. So I will wait a little bit more to actually lock in this as a potential reversal. Usually what I'm looking for, and that's a kind of a good tip for everybody, is that you need to see a 5-wave move on the upside, which is actually challenging the previous swing highs. Higher it goes on the upside impulsively, the higher probability is that this was the actual low, and the pullback is something that everybody should look on. So let's look quickly gold, and I will complete this macro with that. So gold is still, in my point, bullish. RSI, if you look on the weekly level, is also historically kind of trying to reach this couple of spots that we have where we had a reversal. 200 moving average now becomes very playable here. We are actually now testing it on a weekly level. There is a couple of fib levels here which makes a fib floor, which gravitates between 1,554 and 1,650, so $100 of a difference. I do still see this as a potential flat and reversal on the upside. Of course, I say always wait for a higher time frame confirmation, wait for a 5 waves up, confirming and testing these previous swing highs, and then on a pullback, your risk is actually very small, and I think it's a good way to actually minimize your risk if you look some of these assets classes continuing further on its trend, which I think currently we don't have any reason to believe that this was a top, because this kind of goes well from several Elliott wave guidelines of the right look and also proportion between the wave 2 and wave 4. So now I'm still going to hold the bullish view of waiting for this confirmation on the upside. So back to you guys.
Very good. Much appreciated, Alex. I'm going to pass the screen over to Todd. He's got that coming your direction.
Yeah,
Markets.
good work.
Yeah, go ahead.
Good work there. Yeah, no, go ahead. I'll update them.
No, I was just going to say we've got markets have been open about 21 minutes. Markets challenging 3880 currently in the S&P. Members, we've got our webinar coming up here in about 10 minutes. What do you got, Todd? What are you seeing?
Yeah, I was just going to, Alex, just the one thing to keep in mind with tips, just watch that break-even rate. I see what CNBC is printing. You opened up there with the tips showing a new high, but watch that break-even rate. So this is, you look at where the tips market is pricing inflation 5, 10 years from now. I can't get a 2-year. I wish I could on Y charts here, but the tips actually topped out here in March. So the 5-year inflation expectation was at 3.59%, as the 10-year went up to about 3%, and they have dropped about 50 to 60 basis points here over the last couple months. So from March, you're looking down, and so inflation 5 to 10 years out, the market's looking at 2.5, right where we need to be. And which I find interesting, if you just throw XLK over there, technology ETF, you can see there's a pretty good correlation with them really over the last 2 years. But what I find interesting is XLK, much like interest rates and yields, as you just said, yields are making a new high, bonds are making a new low, but NASDAQ and stock market is not. And actually the tips inflation break even are making new lows. So looking out, I know 5 to 10 years is a long way from now, but perhaps the scare that we've seen in the stock market here because of high inflation will come off, because now tips break even expectation is more normal of where we've been. The stock market is making a higher low as inflation's normalizing down to where we expect it to be. So maybe this direct correlation is going to come to an end. And again, I guess I'm showing my hand being a little bit more bullish here, but if those inflation expectations stay there, maybe that direct correlation breaks apart and stocks move higher. So just want to put that in front of you.
Very good. Much appreciated, Todd. Yeah, go ahead, Alex.
As I said, I do expect 10-year to reverse and go lower somewhere soon.
Yep.
So kind of a whole of the picture completely technically and fundamentally for now agrees with a potential reversal. So I'm not going to speculate technically where it's going to go, because we all have our sides. But I mean, what you have said, it's completely agrees with all of this, that we are going to go and see a correction soon, which might take a year because rates are moving slow. We can even have a pause in rates for 1.5 years, 2 years. I mean, who knows how much that will take, I think that will be enough of the time for your perspective on the higher time frame, which you didn't discuss here, which actually calls for another all-time high.
Yeah. Good show, guys. Throw a thumbs up if you're watching in there. Trade analysis. You guys brought the noise today. Good discussion. I enjoyed it. Thank you.
Absolutely, absolutely. Glad to have you with us. All right, members, we'll see you in about 5 minutes. Viewers, traders, investors, if you did enjoy the content, please subscribe with notifications. It's a great way to support the team. Doesn't cost you anything. Give it a thumbs up, drop a comment, and we will be back, of course, same time, same place next week. Check us out, anytimetradinganalysis.com. Alex will be back with you tomorrow morning, 9 a.m. Eastern, for Crypto Lab. Team, have a good one, and we'll see you guys all next week. All right.
See you guys.
See you guys.
Be safe.